Ready to pass the CPA exam faster? Visit cpapass.ai. Today, the GAAP rule that saves your balance sheet, net realizable value. Trade receivables represent your legal right to collect cash from customers who purchase goods or services on credit. On the balance sheet, these are classified as current assets. However, the harsh reality of business is that some customers will default. To prevent overstating assets, GAAP requires companies to report accounts receivable at their net realizable value, or NRV. NRV is the net cash amount you actually expect to collect. And we calculate this using a simple formula: gross accounts receivable minus the allowance for doubtful accounts, which is a contra asset account. This presentation ensures financial statement users see a realistic valuation of future cash flows rather than an overly optimistic gross balance. When accounting for uncollectible accounts, you will contrast two methods: the direct write-off method and the allowance method. Under the direct write-off method, bad debt expense is recorded only when a specific customer's account is confirmed uncollectible. Because this delays expense recognition, it violates the matching principle and is banned under GAAP. It is only acceptable for tax purposes or when immaterial. Conversely, the allowance method is GAAP required. It forces companies to estimate bad debts in the same period as the related credit sales. This matching of credit sales revenue with the estimated bad debt expense ensures your balance sheet reflects the true net realizable value of your receivables before defaults actually occur. Historically, companies use two approaches to estimate bad debts: the percentage of sales method and the aging of receivables method. However, under the applicable standard, also known as the current expected credit losses, or CECL standard, the percentage of sales method is no longer permitted under US GAAP. This income statement approach is banned because it fails to measure the actual expected credit losses of outstanding receivables at the balance sheet date. Instead, GAAP now requires a balance sheet approach, such as the aging of receivables method. The aging method groups outstanding receivables by age to calculate a target ending balance for the allowance account. You must then adjust the existing allowance balance to record the current period's bad debt expense. When a specific customer's account is confirmed uncollectible, you must write it off. Under the GAAP allowance method, the journal entry is a debit to the allowance for doubtful accounts and a credit to accounts receivable. Here's a major examiner trap: writing off a specific account has absolutely zero effect on net income, total assets, or net realizable value. Why? Because both the gross accounts receivable asset and the contra asset allowance account decrease by the exact same amount. Think of it as a wash. The bad debt expense was already estimated and recorded in a prior period. The actual write-off is simply a balance sheet cleanup that removes the specific uncollectible receivable from your active ledger. Occasionally, a customer whose account was written off unexpectedly pays you. This is called a subsequent recovery. Under the GAAP allowance method, you must record this using a two-step process. First, you reverse the original write-off by debiting accounts receivable and crediting the allowance for doubtful accounts. Second, you record the cash collection by debiting cash and crediting accounts receivable. Watch out for this examiner trap. Under the non-GAAP direct write-off method, no allowance account exists, so you must credit bad debt expense directly to record the recovery. Always identify which method the exam question is testing before selecting your journal entries. Practice these recovery scenarios on cpapass.ai to master these crucial balance sheet mechanics.